sometimes it's referred to as the how to trade class. And that's really what we're going to be talking about today is how do we physically place a trade? Once we know what to trade, we talked about that in week one in terms of stocks, ETFs, mutual funds, bonds. These are all different tradable, investable securities. We talked in week two about methods of research and analysis. How do we determine what stocks? Do I even want to own stocks? What ETFs, what mutual funds, what bonds to buy? What should I buy? What kind of mix should I buy? What are some thought processes there? And of course, that's going to differ with everyone. There isn't one single solution in terms of what you should own. It's going to be different for different people. But then once we understand, okay, you can use fundamental analysis, you can use technical analysis, you can use a hybrid of both approaches. We talked about that last week. This week, we're going to talk about once you've done your analysis, once you determine what you're trading, what you're investing in, you've done your analysis, you've made your decision, how do you actually own or place a trade to buy what you'd like to buy or to sell what you'd like to sell? This is going to be, in my opinion, this should be the easy part, right? I think the harder part, and this is purely my opinion, my take on the subject, and Jake, I'll certainly welcome yours in a few moments here, but this should be the easy part. The physical act of trading is merely just clicking buttons. Back in the day, we had to call up our broker. Hopefully, we weren't on a hold for too long. We told our broker what we'd like to do. They placed a trade. They filled out a trade ticket. They gave it to a person called a runner. They would run it down to the exchange. It probably went through a tube first, those tubes like you see at a bank. And then the runner would give the ticket to a market maker. The market maker would find a counterparty to the trade, place the trade, stamp it, clip it, something, and it would be given back to the broker, and then eventually the allocation or the confirmation would be sended to the client. All that would take days. We now just do it with a couple clicks, and it's done in seconds. So now that I've shown the disclosures, let me jump right into it here. I'm going to go ahead and go to fidelity.com. And again, if you're joining us for the first time, welcome, welcome. You can kind of join and do these classes or these weeks a little bit out of order. We do encourage you because they tend to build on each other. But if you've missed it, just a reminder, it's going to say in the upper left-hand corner it's being recorded. It's not, it's recorded for compliance. It's recorded for quality assurance. We want to make sure we're doing a good job, and occasionally we need to review some things. So if you do miss this class or if you've missed some of the others, you can go ahead and register next month. We run this class every single month. And again, if you attend this class and maybe you miss some things or certain aspects are unclear, there's nothing wrong with attending it a few times in terms of focusing on certain aspects, making sure you understand some of these concepts, because of course, these are the foundational elements of trading investing. If you don't understand these, it's going to be really hard for you to move on to more advanced topics. So just a reminder, if you're on fidelity.com, you're going to head over to that news and research tab, go down to where it says learn. It's the bottom of that drop down. You'll go over to the left-hand side where it says events, and you'll see all our content. We have, again, different coaching sessions that we'll host every single day. These are going to be a huge list of rotating topics in terms of indicators, tools, technical analysis, options trading, you name it. And we do have recurring monthly classes that you can attend as well. You're in one, it's the Trading Basics class. After attending this class, we would certainly encourage you, if you want to learn more, if you want to add to your educational toolbox, so to speak, we would certainly encourage you to check out our other classes like the technical analysis class. Maybe you want to become more proficient with the Active Trader Pro platform. If you're newer to Fidelity, or maybe you've been trading at Fidelity for a long time, if you're getting more active, you might want to check it out. It's a free to download desktop application. It could add a lot of value and simplicity, or perhaps an additional layer of customization to your trading experience that could really be helpful for you and really be useful and practical for you. So let's jump into the Trading Basics. I'm going to go ahead, click into our Trading Basics. We're in the month of May. We're going to use some slides today just to talk about some theoretical textbook-based concepts before we go into some of the demonstration-based portion of today's session. You can find the link to the slides here right next to where you register. Assuming you are registered, you can also go into here and you'll see a breakdown of what we cover each week. You'll also see the homework. So let's do that. We're going to jump right in. And so if you didn't attend, you don't have to turn these in. It's not graded, it's not required. It's just something we do to review what we covered last week, just so if you're joining us for the first time, we're not building off of a completely foreign topic here. So last week, we talked about research and analysis. We talked about the two schools of thought, fundamental analysis and technical analysis. There are some other things you can do. You can read tea leaves. You can pull a name out of a hat. You can throw a dart at a dartboard that has ticker symbols at it. There's a lot of different ways you can make decisions, but there's two primary schools of thought. And maybe you'd like to tell us in the question and answer chat feature, what approach do you use? Do you use a hybrid of both approaches? Do you maybe only look at fundamentals? Do you maybe only look at technicals? Is there a reason you prefer one or another? Feel free to let us know. We're happy to hear your input on this. But here's a couple questions that are going to be surrounding this topic, and it's not multiple choice, so this is more the short answer type of format here. So answer or question number one, which type of analysis focuses on the study of a company's balance sheet? A balance sheet is an accounting financial statement. It's also referred to as a statement of financial position. It tells us, as of this date, here's the amount of assets a company has, here's its liabilities or its debts, and the equity is the difference between the two. That is going to be within the fundamental analysis in terms of its housing there. So when we look at fundamental analysis, we want to understand the company more. And so if we look at a balance sheet, we can understand how much debt does it have. Sometimes high debt can be better for certain concepts. So it's not just, hey, the company has lower debt, that tends to be better. A company could be higher leveraged and could be more efficiently using a lower cost of capital if for some reason the debt markets offer a more attractive way for them to finance their operations as a company. Conversely, if things are not going so well in terms of the sales front, that weakness, that stress could be felt if a company starts to have a hard time meeting its debt obligations. So again, it's more information you have to kind of understand and filter through. Is it going to be good? Is it bad? Companies that are lower debt have more flexibility. However, sometimes they can be looked at, hey, they're not levered enough. If they're not borrowing, do they not see opportunity? And so if you can borrow, again, rates used to be a lot lower. They're quite a bit higher now. But if you can borrow at 5%, and you have a 20, 30, 40% profit margin, well, why aren't you? And again, so sometimes there can be a little bit of a viewpoint there. Question number two, the analysis that studies past market data by viewing a chart is known as technical analysis. It's the other viewpoint. Fundamental, we want to understand the company. Technical, we want to understand the chart, and we study three things on a chart. We study price, volume, and time. Is there a correlation between time and price? If there is, we call that a trend. If there's a positive correlation, that's an uptrend. If there's a negative correlation, there's a downtrend. Higher highs, uptrend. Higher lows, uptrend. Lower highs, lower lows, that's a downtrend. Everything else is just a mix. Sometimes stocks can go sideways. But again, technical analysis, we want to try to understand patterns, understand trends, and then use that information to help us place a trade. We don't necessarily care as much about the company. We care about what we're trading, investing in, what the trend is, and how that can potentially help us make a trading or investing decision. And again, which analysis do you prefer and why? There's not a perfect answer to this. I think there's some merit to both approaches, right? If we want to understand a company, that could help us. There can be times where a stock might trade in a different direction than maybe the fundamentals are necessarily telling us. There can be times where we follow trend and we place a trade, and then the next day there's bad news, something happens, and the price gaps in a different direction, which could be highly undesirable. So no unique analysis is going to be special. A lot of traders tend to segue more to technical analysis. Longer term investors tend to use more fundamental. It's not a hard and fast rule. You don't have to use it in only that context. Again, many traders, investors will use some hybrid of both approaches. All right, number four, can we use the stock screener on Fidelity.com to search for the largest stock by market capitalization? Which do you find first? let's do that. Let's do this real quick. We want to leave plenty of time to cover what we have for today. So let's do this. Again, if we're fundamental and we want to understand aspects about a company, let's go to the stock screener. I'm going to go ahead, click the launch stock screener. This is a very popular tool. If you haven't used it before, we do have sessions and host sessions where we will use and show this tool. We'll spend almost a whole hour on it. So the call to the question is to use market capitalization and just say, all right, let's look at the largest and let's just sort the biggest. If I look at the largest, it shows as of yesterday's close that Microsoft, MSFT is the ticker, is 3.16 trillion, trillion with the capital T. That's the largest company. Used to be Apple. You can see it overtook Apple. Perhaps there's going to be a little bit of back and forth here. Apple's pretty close, only about zero point 0.2, only 0.2 trillion away. So Microsoft is the answer to that question. If we use that same stock screener and the same answer, what is the trailing, so going backwards, the trailing 12-month price to earnings, TTM, trailing 12 months, for that stock? So let's go back to that stock screener. Let's now add price to earnings, the trailing 12-month. I'm going to go ahead and add that. I'm not going to filter, I'm just adding it as a column. And we can see Microsoft has a 37.2 trailing 12-month price to earnings ratio. Again, the ratio is just what it is. You have to usually filter some type of prism. Is that high? Is that low? Well, if it's high, maybe it's high for a reason. Maybe it could go higher. If it's low, could it go lower? Could there be a reversion to the mean? Is it too expensive? Is it too cheap? Again, I think we need more information apart from just a bland one ratio. Fundamental analysis requires us to do a more holistic look just to gain as much information about the company as we can. All right, let's use the ETF screener to find one with the highest 90-day average volume. Which ETF do you find? I actually know the answer to this question, but let's just, for exercise sake, let's take a look. I'm going to go to News and Research. I just clicked on ETFs, and this is going to lead us to the ETF screener, the exchange traded funds. I'm going to go ahead and launch the screener tool. And we're going to use, I'm going to close this. We're going to go down to trading characteristics. I'm going to go to volume, and it says the 90-day, I believe, average trading volume. We want the very, very highest. I'm going to just look at the very highest. And of course, lo and behold, it is SPY, or frequently referred to as SPY, the S&P 500 ETF that tracks the S&P 500 index. And it has a 90-day average volume of about 70 million shares traded per day there. So SPY was the answer to that question. Last question here, using the answer from question 6, what are the top 3 holdings of that fund? We're going to go into SPY. We can click SPY. I know I have a number of different tabs open here. Maybe I want to close a few. We will give it just a moment or two to load. Perhaps I want to try it again. Let's try it one more time. I know I do have a number of tabs open. There we go. It's loading now. And once we click on an ETF or a stock, this is going to be where we're going to do most of our fundamental research in terms of looking at these tabs. Let's go to composition. It's going to tell us what's in the fund, what's in the ETF. We can read about its stated objectives, make sure it fits our goals. What are the top 3 holdings? Well, Microsoft is the top, Apple's the second, NVIDIA is the third. So Microsoft, Apple, NVIDIA are the top 3 holdings of that fund. So that concludes the homework. With that out of the way, let's start talking about how we trade. And for that, I'm going to turn it over to my colleague, Jake. Jake, why don't you talk to us a little bit about trading, maybe some of your thoughts on the homework, and get us going here.
Welcome, everybody. Thanks for joining with us. We do want to make sure we make good use of your time. It's been 15 minutes. I didn't see a lot of questions resulted in last week's material. So if you have questions, send them in. But we'll go ahead and march it forward based on your silence taken as understanding. Hopefully, we're not over over attributing your understanding, but we'll take a look. Today, we're going to talk about the various balances you can see when you open up your trading account. We're going to look at actually placing trades potentially on margin and talk about what margin is. And we'll spend a bulk of the time on the actual placement of these trades. What does it mean? So let's first define a few things about margin. Margin is the ability to borrow in order to invest or trade. Now, that sounds scary to many initial beginning investors, and that's okay. If you are one that says, I will never do that, that is a reasonable choice. You do not have to. However, Troy just talked to us a little bit about some of the reasons that debt can be good for a business. If you have profitable margins, then using the margin trading figure to actually borrow does allow you profits. It is foolish for you to borrow in order to lose money. That is the problem, and we don't want to amplify our losses. But what happens with margin is that you take the value of the stuff that you own, in this case stock, bonds, or mutual funds, and you borrow against that value, just like you may have borrowed against the value of a car or a home in the past to get a home loan or a car loan. Even though you haven't paid for all of it, you can buy more than your money's worth. And that often is something we are comfortable with in those parts of our financial lives. For whatever reason, in the investing world, we view that as excessively risky. I might point out that if you are one who is borrowing money to buy, especially a new car, you are borrowing money in order to expect to lose. If there's a foolish decision on the table, I would encourage you to point at that particular direction, as opposed to about thinking about borrowing in order to invest where you expect to earn money. However, like I said, there is no requirement that one use margin, and I encourage you to use caution, as it does increase your risk one way or another. So when we think about margin, it is easiest to understand in terms of buying like a house. You purchase a house with a down payment of your own money, and the bank fronts the rest. And the bank's amount, that loan, is a fixed amount that you have to make payments on and eventually repay. If you don't, the bank takes the money, takes the home, right? They were to repossess. In the case of margin, the thing you are buying is stock, and the person who is lending you money is your broker, in this case, Fidelity. Fidelity would indeed require that you repay that loan, but we're not interested in your stock. Instead, if you are unable to pay back the loan at some point in the future, all you would need to do is sell your securities, at which point everybody walks away with their respective portions of the pie. As we look at this overall investment, the keys are that margin is borrowing. It means that you are going to be taking on some debt in order to potentially buy, but there are good things about it as well. Those are the risks, and I hope you see my conservatism in relation to it. So what are the good reasons? Why is it beneficial? Well, especially if you expect to trade frequently, margin is a huge benefit. The reason is that the way the laws are written require that your money only be used once at a time. And at a time is kind of a strange scenario. When you and I go to the grocery store, we make a purchase, we swipe our card, you pay with cash, you do whatever it is you're going to do. But often there's a delay between when you swipe that card and when the money may come out of your bank account, or perhaps charged to your credit card, which you then pay a month and a half later when the bill comes due. Well, regardless, there is a potential delay between the actual transaction and the transmission of money from one person to the other. As a result, we recognize there is a little bit of a kind of a bridge, this time in between. So that's where margin comes in. When we work with the stock market, if you buy something today, you pay for it 1 day later. Now, it's actually technically 2, but it switches to be just 1 day later, starting 1 week from today. I'm just going to say that it's a 1 day delay. So if you buy a stock today, you're going to have to pay for it tomorrow, is the way it's going to be starting 1 week from today. And the way that works is then if you were to buy something today and then turn around and sell it, then you neither have paid for that item nor have you received the money for it, but you have both fixed your price for the purchase and for the sale all in one day. So theoretically, that money is yours to use again if you chose to do so. Suppose you bought stock A, maybe we'll call it stock Apple. Let's buy some Apple stock, but then you realize right away that was a mistake. I didn't mean to. I actually wanted to buy Microsoft. Well, by buying one, selling it right away, and then buying something else, we have used the same dollars twice. That's okay in some situations, but it does get us into a sticky scenario where we may get ourselves into trouble. Margin simply says, I know that you have the money. You paid for the stock, then you sold the stock, so you have money coming in, and it's operating on the reality of the moving money all around and taking into account grand total. Have you paid for it? Have you sold it? I'm not sure if that makes a lot of sense here, folks, but unless you intend to be trading extremely frequently or you intend to borrow that money and invest more than your total current investment account, then I will tell you margin perhaps is not the right one for you. We'll leave it at that in terms of margin. If we look at this one right here, and we start thinking about what it means to buy or sell, we have to learn a few more terms. I know we learned a lot in our first week, but here we're going to learn a couple that maybe you haven't come across before. Bid, ask, last, and net asset value. Some of those have meanings in most of the world, but let's define them for us as traders and investors. The bid is the highest price that a prospective buyer will pay for a security, and the ask is the lowest price at which a seller will be willing to sell their shares. When it says the last price there, it's saying who is the last trade and what did that occur at? So if we were to think about this in terms of, again, cars in this case, the bid is what you walk into the car dealership saying, I'm willing to pay you $20,000 for this car. That's your bid. You have raised your paddle and said, I am willing to pay this much. The ask is the price that the car dealer says they are willing to sell to you for. They say, I won't do 20, but I will sell it to you for $24,000. The last trade price is what the last guy who left the lot paid. Now, I don't know about you, but it might be interesting to me to know what the last traded price is. But I'm more concerned with what I'm willing to pay and what the seller is willing to pay. Because maybe the last guy, I don't know, maybe he got taken advantage of. I don't know. Or maybe he represented a very large firm and was buying 100 vehicles and got a bulk discount that I simply don't qualify as Joe Schmo off the street. The last trade price is probably not what we need to concern ourselves with too much, except as a general gut check to see if this is reasonable. We're most concerned with the bid and ask, which are the current prices that we could make a deal if we are willing. If I'm willing to agree with a dealer's price at $24,000, then I shake their hand. I walk out of there with less money, but with a car. Or if I am unwilling to do so, then I simply put out my bid saying I'm willing to pay $20,000. You just let me know if you change your mind, and they come back if they ever do. Those three are the ones we're going to focus on. The net asset value we talked about briefly in the first week when we talked about what different assets are. We learned that funds, like a mutual fund or an ETF, will trade in respect to their net asset value, the value of all of the stuff inside the fund. So we won't spend too much time thinking about that one. These ones are our main focus: the bid, the ask, and the last. Knowing that there is a bid, knowing there's an ask, and knowing there's a last, we need to start thinking about what shows up. So a stock or an ETF, anything in fact that's traded on an exchange, hence the name exchange traded funds, will have a bid, an ask, and then the last price will also be shown. So let's go ahead and take a quick glance at that. If we go ahead and pull up the Microsoft chart, since that was the largest stock we saw previously, let's go ahead and grab a look at it. When I type that symbol in, here's Microsoft. This one displayed in big bold letters over here is the last trade price. Somebody paid $429.04 to somebody else for some shares of Microsoft. Over here is the part we want to pay a little bit more attention to as prospective investors or traders of Microsoft, the bid and the ask. The bid is the line of all of those willing buyers raising their paddles at the auction saying, I will buy, I will pay $4.29 and 1 penny. They won't pay you anything more than that, but that's what they're willing to pay right now. On the other hand, sellers are raising their selling paddle and saying, you know what, I'm willing to sell, but I'm only willing to sell for $429.05. You don't pay me those full 5 extra cents, I'm not going to sell to you. And they're waiting. Right now, the buyers aren't willing to pay enough to match the sellers. So there is not an immediate deal. A deal comes with one of them either bending to the other's will or a new participant coming to market. There is a buyer, maybe many of them. There is a seller, maybe many of them. But there also could be a third person. You, me, Troy, steps in and says, I'm willing to buy. And sure, I'll give him the extra 5 cents. I'll buy at $429.05. I am looking as a buyer at the person I want to make a deal with. The ask price, that's the line of willing sellers. So I'm going to focus on and look at the ask. If I am instead wanting to sell some of my shares of Microsoft, I've owned them for a while and I'm ready to get out of it. I want my money back, ready to go ahead and do whatever is next. Well, I am now competing with these other sellers that want $429.05. I could join them if I want by trying to sell for this same price, or I could undercut them by selling and agreeing with the willing buyers right now, ready to make a deal with me at $429.01. There is no right or wrong in terms of which price you should aim for, but you can see that as a buyer, if you are willing to pay the higher price, well, you jump to the front of the line and you're able to go ahead and purchase the shares when you want. However, if you are a seller, you need to instead bring your price down in order to attract buyers and to be able to get rid of your shares. If you choose not to bring your buying price up or your selling price down, then you're simply saying, I'm going to wait until somebody else agrees that my price is a reasonable price, and then I will have a deal. You're saying that the price you've chosen is more important than the timing of that trade. Knowing that that's the case, we can start diving in and understanding a little bit more about the different types of orders, order types that show up when we go ahead and jump in and take a look at a trade ticket. Let's suppose that we've got cash in the account. You're ready to buy your first shares of stock. You come down here and you click on the buy button. Well, when I hit buy, we see a number of different things. You could figure this stuff out for yourself. Select an account. Oh, okay, I need to choose my account. This is a test account here at Fidelity, not my real account in case you're curious. But here we've got a test account. Here's the amount of money available for me to buy with, and I'm working with Microsoft stock. It looks like the price has changed a few cents since we looked at it over here. The current bid went down by a couple pennies and the ask went down by 1. However, if we come down here to the order type, well, now we've got a number of different areas that we could choose from. We're going to learn most specifically about these first two, the market order and the limit order. And they all define and rely on this difference. Do you want to be in line with your competition of other buyers? Or do you want to find the person you want to make a deal with and shake their hand right now at their price? That's our starting point for understanding these. So let's take a look at the types of orders. Troy, I'll explain these and I'll give you a chance at them as well. But folks, the key is this. A market order is saying, I just want the shares right now. I'm willing to agree to the used car dealer's price. I'm willing to buy shares from whoever happens to be selling right now. I'm ready to make a deal. I'm not trying to drive a hard bargain. I just want the asset. If that is you, then we're going to use a market order. Now, I've used the terminology and example of a used car. Now, used car salesmen also have a stigma, don't they? They've got their hair slicked back. They're ready to take you for a ride in more than one way. Well, here, folks, we are instead able to rely on a few other reasons on why this is not a sketchy under the overpass used car salesman. No, instead, we're going to look at this at a relatively safe way to interact with the markets. A market order is the way that you buy actually most things in your life, especially gas for your car. When your car is on empty, you fill it up. You groan and you moan and you whine if the price at the gas pump is too high, but you fill it up regardless because you are interested in owning that. In fact, you need it because otherwise you can't get back to work. You can't get to home. You can't do whatever you need. And so we use a market order mentality. But what this actually tells the market is I am willing to buy or sell at whatever the price is. Just fill my tank up. Okay? That's what I'm interested in right now. If you are buying something that is being sold right now, like when you pull up to a gas station, you know the effective price it's going to be at. You know right about the same amount, right? That's the case with the stock market. You know more or less what it's looking like as long as you're trading Microsoft or Apple or some of these very large, highly traded securities. But if instead you said, I'm willing to pay you, car dealer, any price you want, just sell me the car. Well, there you might get into some risky business and walk out of there with barely any money left to your name. Let's make sure that we're careful. Even in the stock market, you can get yourself into trouble if you trade stocks that are not liquid, stocks that don't trade a lot. Here's an easy way to tell if it's liquid or not. If you and everyone you know is familiar with the name of that company, odds are that its stock is probably liquid. But if somebody had to clue you in that this company exists, you heard a hot tip from your uncle, from your nephew, from your cab driver, well, it might be worth double checking if this is something that is widely traded and has some protection in place for you to go ahead and say, yes, charge me any price you want. I'm willing to pay. The key is a market order focuses on immediate execution of that order, and it's willing to accept the other trader's price. It's the flexible order. It's the one that says, yes, get me in and get me in now, or get me out and get me out now. That's a market order. A limit order is more similar to how we act in other parts of our lives. For example, as much as I love going on vacation and would certainly enjoy going on a beautiful trip to cycle throughout the Netherlands, if I was to go ahead and see the tickets for those flights are $5,000 a piece, I just can't afford it. And I say, I guess I'm going to have to save up. I guess I'll wait. Maybe we're going to go instead to a nice local destination. A limit order is often how we act in those cases, or buying a car or buying a home. A limit order says, I'm willing to, and in fact, I want to right now, but I simply have a budget. This is how much I'm willing to pay and not a penny more. Maybe because I don't have it, maybe because I'm unwilling to use the other dollars. But regardless, a limit order is saying, I want the trade now, but only if the price is right. A buy limit order says, I won't pay you any more than this much. This is my limit on how much I will pay you. The most I will pay you. And a selling limit order says, I will sell, but for nothing less than this number, your minimum amount. Now, again, that might sound scary if you walk into the car dealership and you say, I'm willing to pay you up to $30,000. Well, they're going to charge you $30,000, right? If they will make a deal at all. In the stock market, again, we are protected in substantial ways. Specifically, a limit order says at your price or better. And the or better is guaranteed by law. If there is a better price available, you will get the better price. So when we swing back over to the Microsoft page and we see that right now there are sellers willing to sell to me for $4.29 and 4 cents. If I walk in and say, I will pay you up to $430 per share, in other words, if I choose buy with a limit of $430, this tells the marketplace I will pay up to $430, but they're obligated to instead give me the shares that are available here at $429 and 4 cents. Now, this gets a little bit strange if, again, you are trading something that is not highly liquid. Notice the little X1 here. That means there is one round lot of 100 shares available at this price. There is 100 shares being sold, offered for sale at $429 and 4 cents. If I have a lot of money that I wanted to buy into Microsoft and I want 200 shares worth, well, they are obligated to give me 100 at this price because those are the ones that are on sale and marked that way. Just like when you go to the grocery store, if the sign is wrong, they have to honor the price that is on that sign. This is the price that's on the sign. This is the one you're going to get for this many shares. If you're buying more than that, then you get the next available price after that. Maybe that's at $4.29 and 5 cents or 10 cents or 15 cents. But in no case would it be greater than your limit price, which is where you said, higher than this, I simply won't pay. I hope that starts to make sense, folks. What's happening here with a market and a limit? The key is market, I want it now, no matter the price. Limit says, I want it now, but more important to me, I will walk away empty-handed if the price is not right. Okay? All right, Troy, any additive thoughts there, or can we move on to our next topic?
Yeah, I think one question that we get a lot, Jake, when we talk about market limit orders, people will say, do you prefer a certain order or what order do you use? And I'll be honest, I use a mix, right? And it's going to depend on your situation. There's not a better or a worse order here. I think what's really important is just that you understand how each order works. At the end of the day, depending on your strategy, are you a longer term investor? Are you a shorter term trader? Both are going to use a mix of these, or longer term investors might be a little bit more price sensitive, right? If you're a value oriented investor and you see a stock that's moving pretty quickly and you say, all right, I want to buy, but I'm not like jumping right now to buy. I'd like to get a pretty decent price. A limit order might be more appropriate in that scenario where you care about the exact down to the penny price you pay because maybe you've done your analysis and you think, all right, I'm thinking that the stock could be worth X by, so many days, years, etc. So you want to make sure you pay a decent price. Whereas a short-term trader might do that as well, but they might say, all right, I want to be a little bit more aggressive. This trend is really strong and this thing is moving. Well, if a stock is trending up very quickly and you say, I want to pay this price or better, if the stock moves quickly above your price, I'm gonna tell you a spoiler alert. Your order is not gonna get filled. And so what you end up doing is you end up moving your limit up, and what you're doing is you're chasing the market. And so the market order puts you on that side and says, who's the available seller? Give it to me at the best available price. I want in right now. And that basically means if there's gyrations in the stock, you might enter a market order at a slight up gyration. So you might not get the most competitive price in the time frame of maybe a minute, 30 second, because the idea is you're just slapping an order and saying, hey, just fill me whatever's available, just give me in, that's what I want. Or if you have the stock and you're trying to exit, you're saying, I want out. I don't care what price you fill me, just get me out. I want out now before it gets potentially worse. That's basically what you're saying. So if the trend is really strong, if momentum is really strong, a lot of times a market order can arguably be more attractive. I've still heard people using limit orders. Even in that, they'll say, hey, the trend is really strong. I'm going to try to get in here at this price. And if it moves away from me too quickly, I'm not going to chase. So again, there's different styles. So those are kind of some basic concepts there. Jake, was there anything else you wanted to kind of go into real quick? I kind of wanted to show this concept a little bit more.
Yeah, we did get a question that I think is worth calling out there for anybody else who has the same thought. Natawara says that penny stocks trade at limit, correct? All stocks trade with a possibility of market or limit. You get to choose. You're saying, this is what I want, stock market. If you want to pay any price, no matter the price, then market order is what you are saying. Limit order is saying, I'm willing to trade, but only up to this many dollars. Penny stocks are those hair slicked back car dealers that you need to be cautious with. I would never recommend you use a market order with a penny stock. Likely there is limited liquidity, and there you may get yourself in substantial trouble if the price moves. So be aware that that is the case. Make sure that you recognize that all orders to the marketplace are what you want. There is no right or wrong thing to order at your favorite restaurant. You are ordering. This is your order. So you could place your limit order higher or lower. You could place it to buy, you could place it to sell. You can do a market, you can do a limit. There is no right or wrong. What is wrong is misunderstanding. If you are mad at the restaurant because they delivered you steak when you told them steak, but you wanted chicken, that's your fault, right? Tell them chicken if you want chicken. We are translating these orders now so that you know what you are ordering. That's the key consideration as you work through. You're welcome to go ahead and march us forward, Troy.
Yeah, absolutely. Let's take a look a little bit more at just this concept of, again, market limit order. And what I'm going to do is I'm going to use that same example that you used, Jake, in terms of using Microsoft. I'm going to actually go and just a quick reminder, just kind of a FYI for that trading. In addition to the trading screen that you showed us, Jake, we can also go to our portfolio page. You'll notice here it's a very quick and easy way to place a trade. Folks, again, placing a trade should not be the hard part. The hard part should be the analysis, are you an investor? Are you a trader? What's your appropriate mix of stocks, bonds, and cash? What's going to meet your goals? That's more the hard part, right? Saying, hey, I want to buy some shares of Microsoft or of Apple, it's just a couple clicks. And so, again, there's a couple details you want to know about market and limit orders, but make sure you're not missing the forest for the trees, right? So that's just, again, a quick thing. You can access it on your portfolio page. Also, if you go to your positions at any time, you can click on a position. It has some buy sell buttons right here. It'll also usually give you a button depending on the type of position to close. So there are a couple different buttons that can kind of guide you through the process. But I just wanted to show and illustrate this concept because I think illustrations are important and they matter. I'm going to go to, this is the Active Trader Pro platform. Again, you'll see us use this a lot if you join us for daily market briefings or other sessions where we talk about, more active trading. Here's a minute by minute chart of Microsoft. So this is Microsoft and how it traded just today. Each of these candlesticks or bars represents a minute, right? And again, don't want to do too much. I know this is a basics class, but the idea is during today, it traded as low as around 425 or so and as high as about 432. So stocks move. Some stocks are more volatile than others. It depends on what kind of industry they're in. If it's a more of a stable business versus if it's a growth business, is there news today that has exciting investors or traders? Is today a slow day? Today markets are a little bit mixed today. So there's a little bit of a mixed picture going on right now. But just to serve our example, let's say during this sequence, this is about, I'm zooming in here, this is about, let's say 9:50 a.m. until about 11:50 a.m. So this is a 2 hour, just a 2 hour time frame. Let's say you were a very patient buyer and you said, I want to buy at about 400 and let's just say you want to buy at about $430. I'm going to draw a green line at $430. And all I'm doing is showing you that, let's say you were buying around this time frame. If you put your order in, well, the stock during that time took off and moved pretty quickly. It went as high as 432 and a half, maybe a little bit higher. If you put a limit order in, the price is above, and so you're putting in an order to buy it below market price, your order's not going to get filled. What would have happened is if you placed a day order and just said, hey, I want to buy at 430 whenever I can do that. Stock went up, you wouldn't have gotten filled. And then what happened as the day went on, Microsoft started to pull back. And then the idea is it pulled back enough and you could have gotten filled right there. Or if we fast forward a little bit more, you'll see the price actually went below 430 for a period of time. You likely could have been filled there. And if we want to zoom out and say what happened the rest of the day, you can see it actually went under. It went under 430 for a time. It went above, then it went under. So you would have not been filled if you entered the order right here. It would have gone up against you for a little bit. You wouldn't have gotten filled. You likely would have gotten filled right around here. It went above, then it went below. So again, if you're trying to enter a position quickly, and if price is not important, if you enter a market order, it's going to give you again the whatever the best order is. So I think I just wanted to illustrate that in terms of again understanding, in a illustrated format, the idea of okay, do you want to chase? Is that important to you? Be careful about kind of psychological phenomena. And we're placing trades. I always like to take a deep breath, right? I actually, Jake, used to work for a company where I placed multi-million, sometimes even billion-dollar trades for other clients. And when you're placing trades, you want to be careful. You want to make sure you're doing it correctly. Fidelity has a preview button. So after you enter your order, you can preview, make sure you're on the right side of the market. What does that mean? That means if you want to buy, make sure you didn't accidentally click sell. If you want to sell, make sure you didn't accidentally click buy. And perhaps we want to talk a little bit more about available balances, Jake. I think for those saying, hey, I saw a couple questions come in about, is this a day trade? What is a day trade? What is day trading? And oftentimes, again, you want to be aware of what funds do you have that are available? And if those funds are available, are they settled? And oftentimes, again, anybody who needs specific assistance, you want to call and talk to our active trader services team. They can walk you through this and show you and explain things that are more specific to your account value and your account situation. But whenever we're trading, I don't like to trade in a situation where I'm nervous, where I'm holding my breath, and we're chasing. I want to make decisions that I've done my analysis already. I know what I'm trying to do. And when we place the ticket, it's just a follow through. It's just, hey, I did my research. I'm comfortable buying the stock. I'm not biting off more than I can chew. All we have to do is open a ticket, type in our ticker symbol, say, okay, I want to buy a couple shares of Microsoft. I'm going to buy it at the market. It's going to be around the ask price. If I'm going to sell, it's going to be around the bid price. Is this a heavily traded security? Microsoft is. We just looked at the homework. It's the biggest market cap stock out there. Plenty of shares trade every single day. There were also a couple comments that said, hey, what about penny stocks? Folks, there are some stocks that don't trade a lot every day. So you could be one of only a few people who trade a stock. And so you have to approach those securities very cautiously because you ideally always want some kind of you want to be able to enter, ideally, especially for traders, you want to be able to enter and exit a position easily, right? Not saying, all right, if there's not a lot of liquidity, you can see a big difference in these two figures. You'll see here on Microsoft, these move a little bit, but they're usually pretty close. So if you were to get in and if you wanted out, you could get out very, very easily. It's very liquid, right? There are other securities that are not. And so that's where you really want to be cautious and be careful there. If you're more persnickety or you want just a specific price, I could look at this and say, all right, 429 spot 45. I only want to pay 429.4. And I'm not sure exactly your rationale. It's going to be, again, different for every person, but I could do it. You just got to be comfortable that you might not get filled right now. And actually, we can see the price is tucking in a little bit. So, again, just be aware of what kind of trader you are, what's important to you. Don't sweat the process. Make sure you do it with a clear and level psychological and emotional headspace. I always like to throw that out there, Jake. I know we talk about the psychology of trading, and I think that sometimes when we have a trade idea, when we're placing a trade, it's easy to get excited or to get nervous. But as long as we know what we're doing and we're careful, there's nothing to be nervous about. Jake, any thoughts there?
Yeah, you're absolutely right, Troy. So let's go ahead and walk through a few trade tickets. Let's think about the balances. Let's look at them and understand them together. I'm going to start off here, folks, pulling up my screen again. We're on fidelity.com. And here I'm going to go ahead and start off actually jumping over and showing you a screenshot instead from fidelity.com. But this one in an account that probably looks more similar to yours, at least from its starting, the balances that are displayed. This is what a typical account looks like when you open it up from Fidelity. When you open up that account, it has cash available to trade. When you go to a trade ticket, that's what's going to be displayed. Let me show you instead what it looks like if we go to it in this test account. Remember, all I did was find this Microsoft page, which you could do by typing in the symbol you're looking at and then clicking buy. As soon as I hit buy, it's got 3 of these different numbers, and we're going to talk through them and make sure they're understood for those of you who are interested in margin. But let me first talk about cash, okay? So if we are a cash trader, instead yours will look like this. And you are a cash trader, folks, if you haven't made any extra choices. We make the conservative choice on behalf of our customers saying, let's assume you don't want to borrow to invest additionally. Some other brokers, just so that you know, if you have accounts other places, be aware that some of them do include that as just part of opening the account. So if you're not sure, take a look at what your balances look like when you make your purchases and see what shows up there. It's possible you do have access to borrowing unbeknownst to you. All right. As we look here at cash available to trade, that does mean precisely what it says, that you could go ahead and buy right now this many dollars. This much is available for us to make our purchase. We can look at that in several different places, but that's probably almost self-explanatory. The only spot this gets messy, like I said before, is if you plan to be trading frequently. And here I'm talking about using the same dollars more than once in a given day. If you plan on doing that, for example, buying a stock today and selling it today, then using them again to buy stock 2 and selling it, and stock 3, or even the same stock again and again. If those same dollars are being earmarked more than once, that's where you get yourself in trouble. And by in trouble, folks, we're kind of stretching the truth here. In trouble means, hey, you probably shouldn't do that. Nobody in a suit or with a badge is going to come to your door and knock it down. There's no penalty aside from that you might not be able to use those dollars multiple times in the future because that wasn't supposed to happen in the first place. If you don't imagine yourself trading frequently enough that that's going to be a problem, leave your account as a cash trading account. But if you're one of those that's interested in getting a little bit more active with their money, you want the flexibility to buy, then change your mind, turn around and sell and move on to the next, maybe even trying out day trading to do that on a regular basis, you will need to have margin on your account. Margin allows that reuse of money as well as the potential to buy. And it's going to make a little more sense what's happening here with these balances if I first close out of this trade ticket, come back to our accounts and trades menu, and then click on portfolio. This is where you usually land when you sign into fidelity.com. And you'll see that right over here, we have balances. Balances, we click on it, and here's some detailed balances for this account. We find that the total account value is 11,000 and change. This account is invested, so that 11,000 includes both any cash in the account as well as the value of all securities. So if I actually wanted 11,000 $1 bills, I'm going to have to sell everything in the account, and then get the money from the account, if that makes sense. But nonetheless, if we were to sell everything and walk away, we would have $11,400 or so right now. If we come down here, we see that even knowing that part of the account is already invested, we could go out and buy an additional $16,000 worth of investments. Clearly, that would be more than our money because our money is only $11,000. So the reason this is a possibility is because we would be borrowing against the value of that stuff we're buying. We want to go out and buy a whole bunch of Microsoft. We could buy $16,000 worth of Microsoft in order to have the benefits of, if Microsoft goes up, profiting as that goes up. However, we're also at risk that if Microsoft goes down after our purchase, we have just increased the amount that we own of it, and therefore could even lose more than all the money that we have invested. That is a concerning idea. It's one that we're comfortable with, again, in terms of real estate. When you buy your home, you don't worry too much on the fact that you may have only put down 5 or 10 or 20%, but if the home value drops by 20 or 40 or 50%, and then you had to sell, well, the reality is that you would have lost more than all of your money, and that's what they call being underwater in a home. And it happened to many people in 2008, and it was a very painful situation for the economy. Stocks are more volatile than real estate prices in general, and so there is good reason for your gut reaction to be cautious about this, and I encourage it. But this is what that number means. When you see margin buying power, what it means is spend all of my money and all of the money that you'll allow me to borrow against it. It's like asking your bank, what's the minimum down payment on my house? This is how much you could put down. If you go ahead and spend everything, this will put you at your absolute maximum value. However, available to trade without margin impact is how those of you who are thinking, well, maybe I would like to trade more frequently, at least try it with small dollars. I want to go ahead and test the waters and see what this is like. Well, you can go ahead and say, all right, let's use available without margin impact. This is saying, let me play by the margin rules, which allow me to reuse my dollars repeatedly. And there's a few other benefits as well. But also, I don't want to borrow any money. I don't want to pay any interest. That's the number you're going to take a look at. Available to trade without margin impact. Now, there's a few others. If you click on this little down arrow, it gives us some other details related to what types of securities you might buy, how much you could withdraw, and so on and so forth. Since this is an investing and trading class, I'm not going to focus on the withdrawals, but I did want to explain this one right here. With the menu expanded, we see that margin buying power gets a little sub-definition right here, meaning if you buy fully marginable securities, if you buy things like Microsoft or Apple or Nvidia, highly traded, well-known stocks, you're probably going to be getting it at this part. But if you were to buy a home or a car that's in a real bad shape, the bank is going to change how much money they lend you. That also happens in the investing world. If you want to instead use options or penny stocks, then we're not going to be able to lend you much, if anything, against the value of those. So this number over here instead says, all right, I want to borrow everything I can against the stuff I already own, but the new thing I'm buying, I recognize is risky, and you won't let me borrow against that as well. It's still spending all my money, all 56 of my own $100 bills, and the extra that you'll lend me based on the stuff I already own, $8,000. We notice mutual funds is also listed here. Mutual funds is not as a result of the riskiness of the investment. This has to do with the peculiarities of how mutual funds are regulated, and they become marginable after 30 days of ownership. But nonetheless, when you purchase them initially, they are under this non-margin buying power. So balance number one, margin buying power, says this one, key, you need to know, borrowing all my money and everything that you will let me. This one, borrowing all my money and everything you will let me. This is the one that says, I don't want to borrow at all. Keep yourself below this amount if you would like to avoid the possibility of any sort of interest being charged on the account. We often get asked in this class, what are the rates for margin? If you go ahead and type margin rate up here in the top, we'll find the current interest rates for them. They are a variable rate. That means they change over time. If we go ahead and click in, I think it's under this first page here, we'll find the current rates starting at the lowest at 9%. Highest as much as 13% currently based on the higher interest rates that we've all seen recently. So if you want to borrow, that's the type of investment you're looking at. In other words, in order to invest in this, you would have to expect to earn greater than this amount in order to justify that loan, knowing that it increases your risk. All right, folks, we cut it short right at time last time because we didn't have the question and answer. I've dedicated a few extra minutes here in my calendar, Troy. I'm willing to stay on and answer all these questions, folks. If you still have one that was nipping at the back of your mind, now's your chance. Go ahead and send in those answers, your questions right now, and take a look at them. So we'll go ahead and spend the rest of the time just diving through questions. Porter, last name says, so how do you know exactly where to position first? I assume what you mean is, how do I know where to place my order? How do I choose the right number? That's going to be based on the types of analysis that we talked about last week in deciding, all right, I see you, Apple. I recognize this is a great company based on my analysis, right? I'm just saying this as an example. Let's say we decide it's a great stock. We want to be a buyer. Well, if that's the case, 192.5 is approximately the price you would have to pay to get in now. But if your analysis says the company's only worth 190, well, then maybe you're going to place your limit at 190 or 185 because you don't want to pay full price. You're looking for a discount. You get to choose that price based upon your analysis. If you're uncomfortable thus far doing that analysis yourself, I would highly encourage you to join us for the technical analysis 4-week course that you can find at fidelity.com/classroom, where we go over determining these ideas. How do I decide when it's the right time to buy or sell myself? Then we've got a question from, I'm going to say Girija, but I apologize if I'm way off on pronunciation. When you have selected the account that will fund the purchase, you saw a drop down about available balances, including with and without margin. I hope that makes sense now what those two were. When we pulled it up on the trade ticket, that's exactly what we were seeing. We see margin buying power, non-margin, and available without margin impact. Do you see those same three ones we talked about? This one means borrow everything. This one means borrow everything and maybe buy something risky. And this one means I don't want to borrow, but I want to use all of my own money. Anything less than 5,600, I'm in the clear, won't be paying interest. Okay. Girija also asks, is the changing number in the bid column the instantaneous bids or the lowest or highest over the time? Great question. This is what's known as the order book. We are only seeing the highest bid and the lowest ask right now, but they're actually changing constantly. If I click this button, it will be different. If I click it again, it will be different again. It will constantly be changing. It is current as of the second that you load it. However, it does change constantly. So don't be surprised if the price has moved by a few pennies in the time that it takes you to prepare the order. If you're unsure, click that little refresh button right before you place it. If you find that small delay a concern for you as you're placing your trades, we encourage you to take a look at that Active Trader Pro platform, free to download, folks, free to use, but is based on the idea that you want to have streaming full-time live information while you're placing your trades. Well, then I'd encourage you to go ahead and take a look at that downloaded software as the best place for you to do it. But to your other question, is it the instantaneous or is it the highest and lowest? This is the highest bid and lowest ask, which together makes it the best bid, best offer. The national best bid, best offer is the NBBO. And those are the rules I was talking about, saying that when you place your order, arriving to the marketplace, whether with a limit order like the one I described, or a market order that says, just give me as the shares I want at whatever price, whatever price is really at the existing orders that are on the books. Essentially, you're saying, I will agree to whatever other people have already said. They don't get to react in hindsight to you placing the order, unlike that car dealer who's going to certainly adjust their price as soon as you tell them you're willing to pay $30,000 for the car. So over the course of time, that's certainly something to consider. Next one, how to sell a specific lot using Fidelity Online. A specific lot isn't something we usually talk about in this class, so thanks for bringing it up. What this means is if you have bought shares at more than one time or at more than one price, you will have a situation where if you come in and take a look at your shares, you will have a list like this showing the different shares. In this case, 10 shares purchased at 44.78 and 10 at 44.90. Not a big difference, but nonetheless a difference. In your case, it may be a much more marked difference. If you go ahead and do this, when you hit sell, you will find that you do have the ability to make a different choice. But in that drop-down menu where you choose buy or sell, instead choose sell specific, which will allow you to specify which ones they are. There are also ways to set up a default method to take it based on some rules that you set up. Sell the highest cost, sell the lowest cost, the one will have the least tax impact on me currently, so on and so forth. You can go ahead and make those determinations. If you're uncertain on that, I would encourage you to call in so we can talk you through it. Let me hit one more of these, Troy, and then if you still have time, you're welcome to kid in. I just need a glass of water. Porter asks, what is the trader's assistance information? I apologize. I'm not sure what that one was referring to, Troy. If you recall what that is, or if Porter is still in the audience and you want to clarify, feel free to do so.
Yeah, there's a lot of different questions, and again, we can't get to every single one, or some of these are kind of questions that will skirt kind of eccentric topics where we don't want to open a can of worms, so to speak. I think what addresses a lot of the questions that I'm seeing, Jake, is again, with placing trades, we want to do it carefully, cautiously. Definitely we should check out our balances before placing a trade, understand how much do we have available, how much of that is settled. And there can be issues that can happen when we start placing trades with unsettled funds. Jake, I'm sure you encountered this a lot when you worked with our active trader services team. Would encourage everyone, if you go to your balances tab, you go down towards the bottom. There were a couple questions about pattern day trading rules and some of those other kind of unique, more technical details. It'll give you some information about if there's any restrictions on your account, if you've made any boo-boos where you bought and sold something really quickly with unsettled funds. You can always also contact the Active Trader Services team, and they can walk you through and show you some of these tools. Again, when you're placing trades, do it with intention, be cautious. Another big thing too that I'm seeing is people saying, "Oh, can I throw a limit order and then just leave it for here?" What you can also do too is there's also a really cool alert feature you can do as well. Because again, we've all been there for those again who are more investor oriented. You say, "All right, if I want to buy this stock at this price, this stock at this price, can I float out a bunch of limit orders?" And you can. You got to be careful. You don't want to throw out orders where if you don't have the funds available, the system might not even let you. But what you could also do is you can set up alerts where, hey, if there's a stock you like, I mean, we were looking at Apple or Microsoft, and you're like, maybe I want to buy that on a pullback. That's not necessarily a bad strategy. Of course, the risk is if you buy on a pullback, it could pull back more. But the idea is if you are interested on buying low, selling high, you can set alerts and you can say, all right, send me a text, send me an email, send me what's called a push notification when a stock price hits a certain value. And there's other different alert features too. Some will even involve certain technical indicators if you're into that as well. So again, I think that answers a couple different questions that were asked about available balances, pattern day trading rules, and this idea of putting limit orders on stocks that you say, hey, I want to buy it a lot lower. Well, if it's not trading there, you're not going to be able to do that until it trades at that price. So you could be waiting a while. An alert might be a more effective way of notifying you. And then once the price reaches your desired level, you can then go and place a trade. That might be better than having, sometimes issues can happen when you have an order sitting out there for so long. Of course, also too, there's the risk that some kind of news item hits the wire and the stock can move very, very quickly. And sometimes, even though you were upon your first analysis, you think, hey, $40 per share is a great price to buy XYZ stock. If suddenly there's a new report, there's new information that would change your analysis, well, now you have to go in, you have to cancel that order. If the stock moves very quickly, you could end up buying when your mind has changed, things have changed. And so, again, sometimes not having orders floating out there is ideally, arguably, a better way of approaching that type of situation. Was there any other questions? I know you've been talking at a length here, Jake. Was there any other question that stood out to you in terms of being able to answer it today?
Yeah, let's take a look at a couple of these. I want to be extra lenient here with time, so I recognize if anybody has to run, head on your way. But you didn't get asked questions last week. I feel it here in my soul. So let's go ahead and hit these. Let's see. Grisha says, so you can bid on multiple stocks using a limit order with the hope at least one will work. Yes, you certainly can. However, when you place your limit order, if you go ahead and say, I want to buy some Microsoft and I want to buy, and you say, I want to place a limit, and you're saying, I'm going to drive a hard bargain. I want to wait and see if anybody will sell me shares at 425. I'm willing to wait for it. Perfect. Down here at the bottom, we changed the time in force probably to good till canceled instead of canceling at 4 o'clock. But good till canceled means this is going to stick around for the next 6 months. $425. All right. As soon as I say that's the case, maybe for 100 shares, this 100 times 425, 42,000 would be taken out of my available balances. It would be tied up related to that order. So it doesn't mean that necessarily you have spent the money, but we do our best to help you avoid overspending, and we will give you an error message instead that says you don't have enough buying power for this. In this case, I wouldn't even be able to place this first one because there's not 42,000 in this account. We'd have to instead look at what would it be? Maybe 30 shares at most, so we could do some of these at that price. Next question, let's see. Are there any lag time between the placing the order on Active Trader Pro and Fidelity.com? There is still lag, absolutely, but the lag is measured in nanoseconds. We're not measuring it in full seconds or minutes. When you place an order during the market, the only delay in time is the time that it takes the electric currents to run across the wires from New York to wherever you happen to be and going through our servers in between. So I don't feel like there's any extra lag, but there is certainly just the difference of locations and how it works for you. How can you tell what trade charts are for you? Great question. I would highly encourage you to take a look at that technical analysis course so that you can decide whether this is one that makes sense or doesn't. For those of you who are saying, I don't want to do a whole nother 4 weeks just to find out, join us in our afternoon market brief. It starts up here in 15 minutes. So probably as soon as we close this one down, you can hop right into that and you'll see that being done in real time. You'll see what the analysis looks like, what sorts of understanding you can learn, and then the trades that you could place on that basis. You'll be able to see that in live action here in just 30 minutes. I'll show the link in just a moment. Sylvie asks, is there a delay when placing a market order? There is still the same types of delays, but you can effectively think of it as instantaneous. It's as soon as your order arrives to the market, it gets crossed together with other existing orders and you're in business. It's as fast as you can be. If available to trade without margin as a negative, I think I answered that one separate. If available to trade without margin impact has a negative, that means that you are currently borrowing. Call into our traders if that was not intentional. They'll help you get that cleared up so that you can avoid any unforeseen interest payments. Dennis says, when using a margin account with debt protection, does the order type, cash or margin, matter when buying or selling? If you have added the margin feature, leave your order ticket on type margin. Don't make it complicated for yourself or for the computer system. It will end up having errors if you start flipping it back and forth arbitrarily. And in the end, after you make your purchase, it will actually switch the shares in the end to type margin unless you've made an additional decision on there, which is involved with calling into our team. So the short answer is leave it on margin if you've chosen margin is appropriate, Dennis. Great question. Let's see. Mike, can we talk about short selling and buying to cover? What I will say is simply this. The mechanics are precisely the same in terms of click. Mike, if we go ahead to this one right here, instead of clicking buy to start my transaction, I'll be choosing sell short to start my transaction. And when I want to end my transaction, I would choose buy to cover, which is the ending trade for a short selling transaction. Mechanics work exactly the same in terms of placement of the orders, but of course the risks and reasons for placing these trades are substantially different, and a few extra things you need to be aware of, like availability of shares, unlimited potential risk, and others. But Mike, hopefully you're aware of at least some of those ideas. Mechanics of placing the trade are effectively the same. We do just have you specify, yes, I meant to sell shares that I don't currently own. With that, it looks like we're hitting the end of all of those questions. So thank you so much for coming in here, folks. It has been our pleasure to spend some of our time together with you. It has been now 3 weeks in a row. We're working our way right through. Next week, we hope that you'll have spent some time, maybe done some analysis, maybe joined us, or maybe just looked at the stocks you already own. Because next week, we're going to be taking a look and saying, now what? I bought some Apple, some Microsoft, some XYZ stock. What do I do next? What do I think about in terms of when to sell it? How do I end my trades? What's the right time and how do I make those decisions? How do I measure out in the first place the right amount to have held? Some of that risk management discussion will be the main topics for next week, the what next after this. So I hope you'll be joining us next time around, and we'll do our best to keep it closer to that precise 1 hour time frame. But given last week's delays on questions, I wanted to give you the opportunity. Now, if you want to go ahead and find out what technical analysis is all about and see how to do this, join me at fidelity.com/coaching is the website. See how I'm typing it in? Fidelity.com/coaching. Hit enter, and it's going to be this very first link right up here on the page, the daily market briefings. If you hit find a session, you'll find that our afternoon market brief starts up, like I said, in just a couple minutes as soon as the market closes. So you'll be able to see, in this case, it will not be me, I'm not in there, but rather it will be two of our counterparts from our team. Today, their names happen to be Nick and Troy himself. We'll be right back here. So Troy, I wish you well, and hopefully some of these folks will hear your opinions, seeing some of that analysis as we work through. But thank you so much, folks. We wish you all the best, and thank you for your time. Until next time, bye-bye.